If you're under 30, look away now, because I'm here to talk about the general economic background and to try and tie this in some of the comments that we're having at Hardman & Co. from Tony Drury, our guest speaker, chairman of Axiom Capital, on funding. QE3 is likely to be coming in the next few days in the US, and I think it just sort of reminds me to think through what quantitative easement is about and to think what's happened in the past. Intriguingly, obviously QE2, QE1, these are the names of ships, and if you go back to the 30s, the original Queen Elizabeth was partly funded, as the Queen Mary was, by government loan to Cunard, and the government was underwriting the loan to Cunard for them to restart the Queen Mary's failed 1932 shipbuilding, and they did succeed and the economy turned around. And we note how different the current QE is, in that this seems to be all about supporting asset prices rather than facilitating industrial investment, and we're certainly not advocating trying to pick companies and backing lame ducks. In fact, that's what happened about 4 years after QE2, with the Upper Clyde shipbuilders having to be nationalised. But the intriguing point as we see it is that, is QE actually designed to get the economy going? Is it designed to do other things? The two may be the same thing in the end, but it could take a long while, in that we believe that quantitative easement is much more about supporting asset prices, and the microeconomic feedback that we're getting from the small enterprises that Tony Drury is looking at in his study for the Drury report, which is coming out shortly. This is much more about how to look at the supply side. We did in fact applaud the recent cabinet changes on the back of the supply side, and the Drury report will all be about how to get equity into businesses, especially smaller enterprises, to supply things and to employ people. One of the things that we've seen is there's actually quite a lot of money out there. Retail bonds have been going very, very well. They're very frequent now, and at yields which probably are quite attractive to the borrowers. But this is debt, and the Drury report will be about equity. It really is just trying to focus here at Hardman what we're hearing from the enterprising part of Britain, and looking at how to get money in to increase the supply side. QE may be part of this, but to us it seems very, very much about supporting asset prices. Now, if you support asset prices, you get a situation in the UK at the moment, intriguingly. The demand for housing may well be there, but effective housing certainly isn't. Home ownership is falling because people can't get on the ladder. If QE is supporting asset prices, that's hardly a surprise, because there isn't a clearing price being set in housing. This may be also linked into the bank's unwillingness to take hits on their balance sheet. You could argue that QE is designed to allow them to do that by giving them more capital, therefore more leeway. We would certainly applaud that, and if QE in the UK and in Europe does lead to banks taking a more realistic view on their balance sheet, that would be a great thing, and be part of the way to getting asset prices down rather than keeping them up, clearing assets and getting people to buy them, and things would go up from there. Now, the one positive note I will certainly leave you with, we believe very strongly in, is that QE may be different in the States. There we have, and we're looking at the real estate sector here in particular, that's my speciality. We've seen that the banks in the US have been much more willing to take write-downs, to be more realistic about the value of assets on their books, unlike what's happening in Europe, and indeed unlike what happened in Japan in the lost decade and a half from the late 80s. In the US, of course, asset prices in the stock market are staying up, but all important house prices are going down a long way, and that is partly because real estate, particularly in the US, is being hammered because the banks are able to take a much more realistic view of writing down their assets, and they're able to do that because of the support they're getting from QE. So in a nutshell, we think that obviously each depression is different each time round, but just think as to what QE is about and compare what it's about in the US with what it's about in Europe and the UK. There may be light at the end of the tunnel in the US because of the way that their banks are taking more aggressive write-downs, supported in that by QE. Let's hope that ours do here, and let's hope that there is more equity money available to the small entrepreneurs, and here we're not really talking in the Drew report about quoted companies, we're talking about the backbone of getting economic growth back again. Thanks.